Welcome back to Powercast, the podcast where we look at the intersection of technology, specifically artificial intelligence, and smart investing choices. So what's happened since the last time we were together about a month ago? Well, a lot has happened, beginning with a government shutdown that has persisted for more than 2 weeks. Want to know about how the economy is doing? Well, you're not going to find out because the government statistic mills have been shut down. There have been a resurgence of China trade tussles between the United States and China. It all began when China said they were going to put export controls on so-called rare earth minerals. The president then said, you do that, we're going to come back at you with 100% tariff. That sent the market into a tailspin. The president then said, hey, wait, it's going to be all just fine. Then came more concerns about the Chinese not accepting American soybeans, and we're going to get back at them. How? By restricting exports of cooking oil. That's how we're going to go at them. Cooking oil. That'll bring them to their knees. And then perhaps the most important banker in the world, Jamie Dimon, said that he wouldn't be surprised to see a major sell-off in U.S. stocks on the order of 30%. That idea is also supported by a big move up in the so-called Shiller PE, the price-earnings ratio. It is now above 40 for only the third time since the 1870s, and every prior time that has happened, well, it hasn't ended well for stocks, so look out there. And then there's the whole matter of October. October alone is a spooky month. When was the biggest crash in point terms in stock market history? Well, it was in October of 1987. I remember it well. When was the ultimate crash? That was 1929. Also in October. So we're going to start off by talking once again to Liam Boggan of Quantmatix, who's going to tell us how his picks from the last episode did and some fresh ideas for investment this time. But we're also going to hear from Michael Grant, co-CIO of Calamos Investments, and my friend Steve Grasso, the CEO of the trading firm Grasso Global Incorporated. But we begin with Liam Boggan. Liam Boggan of Quantmatix, welcome. Good to see you again. How have you been?
Been good, Tyler. It's been a bit of an adventure in the market since we spoke last.
Yeah, we spoke about a month ago on the day the Fed cut interest rates. What we promised last time was that we would go back and look at what you said, and you are a brave enough man to sit there and have your feet held to the fire. Liam, the last time we were together, one of the sectors that you had lots of negative signals on were consumer discretionary, including the likes of DraftKings, where you were right, and Norwegian Cruise Lines, where basically you've also been correct.
Yeah, both of them were down sharply. I think that DraftKings thing probably took us by surprise. It's down over 18% or more. What we're seeing, though, is continued negativity in that U.S. discretionary space. We're seeing themes in terms of the U.S. auto sector between Tesla, General Motors, Ford, the auto components companies, Aptiv, Borg, Warner, O'Reilly Auto, CarMax, all got negative signals now. We've got negative signals in the likes of Ralph Lauren and
right.
Yeah, so like that whole sector is continuing to deteriorate.
Another area where your prediction turned out to be correct, and then some, is gold. The gold commodity is higher. What do you think now of gold and the gold stocks?
Our system is about as positive as it could possibly be in gold, but against that, it is completely stretched on all of the metrics within our system. So it's outside of all of the top of the band. So there's nothing to say that gold is coming back. However, it is very stretched. And one of the interesting things that we are seeing is that we're seeing some profit taking and some negative signals being generated in the ETFs. So like Ring, the ETF, which is the Global Metals and Miners ETF, has a negative pending reversal. The Silver Miners ETF has a negative signal, and we've got negative signals the likes of Core Mining and Endeavour Mining, right? So it does look like people are taking a bit of profit. It's really stretched. We wouldn't be surprised if gold came back 10%. But there's no signal to say it's going to do that yet.
Let's go to a couple of the categories where we would give you a mixed or an incomplete grade, beginning with Chinese equities. You said they'd be up, they're down. Obviously, there remains trade tension between the United States and China. What do you think of Chinese equities?
We were bullish of Chinese equities the last time we spoke, obviously before the trade tension started to rise again. We actually got a negative signal in China last week, and that confirmed at the end of the week. And so the Chinese market is down. So hence, we're in negative territory here. We have a negative signal in Alibaba as well today, right? So Yeah, obviously China is a bit mixed picture now.
So then let's put that in you have changed your view on China a little bit because you're getting negative signals now as compared with a month ago when you were positive, correct?
Yes.
All right, let's move on to Bitcoin. What do you see there?
Bitcoin, we were kind of saying that Bitcoin is consolidating. Our scores are effectively completely neutral. I'd be negative for a choice, but a really tight range. Probably about, 107 is the downside, 115 is the upside on it.
I've saved the big call for last. Your big call, which I believe you still believe, maybe even more strongly, is that the S&P 500 is ripe for a correction. You said 7 to 10%. It's basically flat since the last time we spoke about a month ago. What do you see now?
Yeah, so this is pretty dramatic what we're seeing now. Obviously, the last time we spoke, it did say that the tech stocks are continuing to drive the market higher. We do have a negative signal confirmed last week on the 3rd of October in the Mag 7 ETF. We've got fresh negative pending signals this week in Apple, Alphabet, and Tesla. The rest of the Mag 7 already have negative signals. I mean, clearly it's got reporting season coming up, so that's going to be a bit of a binary bet. But with regard to the broader US market, we have 335 negative confirmed signals confirmed at last weekend, right? So that is the largest single cluster of negative signals since September 2021, right? So obviously that's something that you can't ignore. And so we wait to see how these things sort of play out. Typically, what happens is that we get the signals confirmed, the market sort of bounces around a bit, and then it kind of rolls over. So we're still in the waiting for it. So the last couple of days of bouncing around, doing nothing to change our view that the U.S. market is at risk, and still we'd be looking at like potentially there's significant resistance 2% above here, right? And we're still looking at like 7 to 10% on the downside if it rolls over. So risk reward can still be taking money out.
We're going to keep that negative call, maybe even with more conviction on the S&P 500 over the next few weeks, and we'll check back next time we get together. Let's look at a couple of the areas that you see as positives within the U.S. or the broader market. It includes utilities and a lone consumer product stock, Chipotle. Tell us what you see.
AI has been the big driver of all, and lots of that thematic stuff that the retail investors have been playing. So we're seeing positivity in the utility sector, and sort of against the trend of the rest of the market. We had a confirmed positive weekly signal on the 29th of September, right? And that theme is continuing to play. The three stocks that we like the most are probably NuScale, Dominion, and Constellation Energy, right? So that's a thematic play, and looking at the broader sector, there's strength across the board. Again, you mentioned Chipotle. So we actually published a research piece last week. So against a background of like heavy negativity in the US consumer discretionary stocks, Chipotle has stood out on our platform with a signal. It has been completely underloved, very heavily negative score, positive signal. The stock has started to move up. They've got results at the end of the month. They've done a tie-up with the Tractor Beverages, which gets them into a completely new space. Be very interesting to see what they have to say at their results. It could be a turning point for the stock.
Let's finish with one area that has been, let's call it sluggish, and that would be oil and oil stocks. What are your signals saying?
Yeah. So oil is very interesting. So we actually have negative signals this week in three of the major ETFs. So XLE, XES, and XOP, right? As well as negative signals in some of the large cap US stocks like Schlumberger, like ExxonMobil, Valero, Baker Hughes have all got negative signals. We tend to see the US large cap oil stocks moving sometimes ahead of the oil price, right? So it's not something we've observed over time, but we're definitely seeing oil is definitely now in our risk category generating these negative signals.
All right, some interesting picks, Liam Boggan of Quantmatix, and real accountability for the last time. The real headline here is your call on the S&P 500 sort of stands, and if anything, becomes more a high conviction call, correct?
Yeah, it's going to be an interesting few weeks going into earnings, but like we are accountable. It's data driven, objective analytics, so we stand by our signals.
Liam, thanks so much.
Thanks very much, Tyler.
Joining us now is a dear friend of mine, Steve Grasso, the CEO of Grasso Global Incorporated, a major trading firm. He says what's on his mind with great conviction and intelligence. Steve Grasso, welcome. Let's start with where the markets are right now. There seems to be a bit of growing concern that prices are a little overextended, particularly in the so-called Mag 7. There have been the resurgence of trade tussles with China. Where are you on the market overall, and what do you think the future may hold over the next 6 to 12 months?
If you look at in April, where we had the tariffs announced, look at how quick we sold off. More importantly, look at how quick we rallied back. We have flash crashes. We have flash bear markets now, Tyler. So if people are worried about valuation, I never let that get in my way of buying the market, because valuation means momentum. And if you're paying a high multiple, but there's free cash flow and there's earnings, I think you just continue to buy the market. So I'm not saying you can't sell off, because I do think you can, but trying to time it, fool's errand.
Fool's errand. One of the things that I know you've had your attention on, beyond the focus on AI, the AI companies, the AI infrastructure builders, is quantum and what that will mean. Is quantum, in investing there, the next big thing in the markets?
What's the mind of the investor thinking? How do I capture that magic in a bottle before it explodes out? So AI has exploded out. What hasn't exploded out is quantum. So even though we've gone from low valuations to higher, the most it can go is exponentially higher than where AI is right now. So if you get the bigger bang for your buck going for the next best thing, and the next best thing for me is quantum. Just think about the entrance of AI in the marketplace. It was only 3 years ago. And what did people say, Tyler? How can people make money in AI? Why are we buying this mood ring or magic dust? Well, it's not magic dust anymore. It's real revenues. So people are saying the same thing with quantum. Quantum was supposed to be 15 years out. Now it's at worst 3 to 5 years out. You have to buy it now.
What are some of the names that you're looking at in that area in quantum?
Yeah, so I own D-Wave. I also own CCCX. That's a stock that I've been involved with lately. It's had an incredible run, and it's actually got real revenues. It's a SPAC merging with a quantum company called Inflection. I'm most excited about that one.
Let's talk about the government shutdown. Talk to me about its impact and what it could mean.
Ultimately, it will get resolved and the markets will recover. And we haven't really even seen that sell-off yet based on a government shutdown. So I just keep investing right through it.
Let's talk about tensions between the U.S. and China over trade. There's a big meeting at the end of the month in South Korea where the president and Xi are supposed to meet. What do you think is going to happen there? Because that one has the potential not only to slow global growth, but also really trip the market, as was seen by the initial reaction.
I think both of them are interested in the same goal. U.S.-China relations have to be resolved for both countries' sake, and I think we'll see that soon.
Peace in the Middle East, but right now it would seem that to the extent that things settle down there, that would take one of the catalysts out from under oil. What do you think?
I think you could see the price of oil being 50. And what does that translate to gasoline prices? That most of the complex needs higher oil prices, but what's an input to the refiners, such as Valero, is you want that lower input price, because that's where they have that crack spread, what they pay versus what they sell it for. So lower oil prices is bullish for the refinery space.
All right. I think you agree in part and disagree in part with our first guest, Liam Boggan. Let's see if you agree with his call that it is probable. His signals are it is probable that the U.S. S&P goes down from 7 to 10% over the next few months.
We could have that over the next 5 days. So could he be right? Of course he could. Is the time period a little, I'm not worried about it, because it's, the most overused statement is not timing the market, it's time in the market. And the more and more I hear it, the more and more it's true, because ultimately time spent in the market, you are rewarded with those gains.
Steve Grasso, thanks very much. See you again soon. With us now is Michael Grant. He's co-CIO of Calamos Investments, and he is coming to us from San Francisco. Michael, welcome. Good to have you here.
Thank you, Tyler.
You have written some provocative things about the Mag 7, the companies that have dominated the markets and AI over the past couple of years. Are you concerned, whether you call it a bubble or not, or a balloon that may lose air, that these stocks are so highly priced and have spent so much on capital spending that they remind you of the market top in 99 and 2000?
There is a commonality with what happened in the late 1990s, and it relates to the euphoria that is driving a spending spree that we very rarely see in economic history. The degree of spending that is being put forth by these large companies is of the scale that we rarely see outside of, a railroad boom or the Industrial Revolution, for example. Over time, of course, we understand that a lot of that capital investment is misallocated, and that today is the conundrum. It's not that the narrative is not real, it is very real. But the spending to build this infrastructure will inevitably include a lot of waste. These companies are expected to spend about $3 trillion building out this infrastructure cumulative between today and 2030. That implies an annualized depreciation expense of about $500 billion. If you add on financing costs, energy costs, and so forth, you have an annual expense to the hyperscalers of running these facilities of $800 billion. And the question is, where are the revenues going to come from to justify that, right? So you need minimum $800 billion just to break even. If you believe the internal projections of OpenAI for their margins, you need at least $1.3 trillion of scale. That's the canyon that has to be crossed, and that's the similarity with the late 1990s.
Can they do that?
I'm skeptical they can do that for many reasons, but two in particular, which I'll mention. There are some very real differences between these business models of the LLMs and the traditional technology or software business. First, what an LLM delivers is a generic answer, a non-proprietary answer. It's like instant access to the right entry in an encyclopedia. And that answer can be copied very quickly, often at lower cost, by competitors. So I think these business models are going to be extremely price elastic, different from what we're used to in the tech world. That's the first problem. The second problem is they do not have or enjoy the economies of scale that a typical digital business does. This is an enormously capital-intensive business, and it's not clear people have properly understood that in how they're modeling future profitability. Our view is that these businesses will be much more like a utility or a chemical company than a software business. These new technologies are directly aimed at some of the traditional monopolistic modes of companies like Google and Amazon and Meta. And it's why, of course, they are spending so aggressively. And this can continue for a long time until Google or Amazon no longer believes that the additional spending on the new model is actually supporting their mode. And that's why the incremental value of these models, for example, ChatGPT 5, released in August, is so important. Because once they decide that incremental model is facing scaling problems, I think they're much less likely to pour money into all of this.
So let's look at the companies you just mentioned, the Open AIs, the Googles, the Anthropics, the Metas, the companies that are on the leading edge of artificial intelligence and whose business models may not have the moat that they ought to have. But on the other hand, there are the companies that are building the infrastructure of this AI world, companies that are in the chip business, companies like an Oracle, for example. Are they going to be beneficiaries of all the capital spending that you cited in your first answer, the $3 trillion in capital cost that you expect to see?
Yes, and that's clearest for Google and Google Search, but it's also apparent for Amazon and Meta. In effect, these businesses are heavily driven by their online advertising cash flows. And the core of what OpenAI is doing, for example, is threatening those cash flows. So one of the big questions for all of this spending is that it is being supported today by what are very cyclical online advertising businesses, and these core franchises are now under threat. I'll give you two scenarios. If there is a pullback in AI spend next year, of course that will impact the S&P. These companies are too large, they're too concentrated. Where they go, so goes the S&P. But I think there is a question about today's economic resilience. And will we continue to see this economic resilience if the AI spending narrative weakens? And we don't know what the answer to that is. It's possible that what we describe as economic resilience is simply a reflection of the fact that we're in the mother of all bubbles. And therefore, when the tide goes out on the AI narrative, we will quickly learn what parts of the rest of the economy actually have swimming suits on. Now, the silver lining is that all of this spending is financed by equity and not debt, right? These companies are financing it by internal cash flows and equity. And therefore, the policy response should be much more like 1987 or 2000 rather than 2008. So alongside the AI narrative is another very important narrative. It is the multifaceted reflation of the Trump administration. And we know that if the spending narrative does in fact begin to slow in 2026, that policy will continue to be very aggressively reflationary. So the silver lining or the silver possibility here is that the rest of the economy, which has effectively been in a rolling recession for the last 3 years, finally enters into a rolling recovery.
So in effect, what you're saying is that these companies, that some of these companies, the Googles, the Metas, the Amazons, are investing and are effectively cannibalizing their own business? Am I understanding you correctly?
I'm going to say that it's both. And the reason is that the momentum of these dollars spent today are so significant, I don't think you could cut it all off suddenly. Even if, in fact, these companies were to weaken, I think much of the spending would still be flowing into the economy for the next 2 years. In terms of where to invest, there's two scenarios. People like to use the word bubble. It's a metaphor. And the problem with the bubble metaphor is that bubbles burst and timing is everything. And if you're one day late, you can pay dearly. The other scenario is that this is not a bubble. The right metaphor might be death by 1,000 cuts. This is what happened to crypto in 2021, 2022. And this is where the disruption or the dislocation is resolved through time rather than a collapse in pricing. And I would argue that's still quite possible. And in that case, You do want to be minimizing your exposure to the mega caps, but it opens up the opportunity for the rest of the market.
So let me cut to a question that I think would be on everyone's mind, and that is this. Can the broader market remain healthy if the Mag 7, these huge super caps, are not healthy?
That's right. So if the mega caps fade, the money has to go elsewhere. And to a degree, we're seeing that already in the broadening of the stock performance within the S&P.
So bad news for the mega caps may mean better news for the remainder of the market, the 493 in the S&P 500. Michael, let's bring back in Steve Grasso for some reaction and maybe a question or two about what Michael has just said. Steve, welcome back. Any quick reaction to what Michael laid out as his thesis?
Yeah, so I agree with Michael when he says the other parts of the market are getting some attention. You do need lower interest rates for the other segments of the economy to actually perform well. But I'm going to broaden it out, and you have to invest where the growth is. Where the growth is technology. So it might not be those 7 names; it might be 70 names that are below them. Stay where technology is, and that's in the S&P 500.
Steve Grasso, Michael Grant, thank you very much. We really appreciate your being with us today. Thanks, guys. Let's check in now with Mark Egan for a couple of shaggy dog stories we call the Zeitgeist.
Thanks, Tyler. I'm Mark Egan from Montclair Media, here with Luna, our brand ambassador. So the 2026 FIFA World Cup takes place in the United States, Canada, and Mexico, with the final at New Jersey's MetLife Stadium, just a few miles from Manhattan. Fans were abuzz this week when tickets went on sale, but their World Cup dreams quickly became a nightmare. Prices were astronomical. The final at MetLife, which holds 82,500 people, the cheapest seat was $2,030. Isn't that crazy? Fans had to buy tickets without even knowing who was playing. You want to see Leo Messi? You could get Cape Verde. There was dynamic pricing, and any low-price tickets that might have been available vanished in a moment. The Guardian's review was savage. What's taking shape is less a global festival of soccer than a fintech laboratory for everything that has made contemporary entertaining so exhausting. This is the World Cup where the thrill of fandom meets the calculus of hedge fund speculation. My soccer friends and I have all agreed we'll watch the games at the pub. Speaking of drinking, it's Sober October, a trend being driven by Gen Z being less fond of alcohol than other generations. Coffee shop dance parties, sober curious nightlife options have been popping up everywhere from New York to London. LA Magazine recently reviewed the best mocktails available, from non-alcoholic sake to non-alcoholic tequila, and they noted the lack of booze didn't make them any cheaper. We couldn't help but notice that just because the alcohol is removed, that doesn't mean the mocktail is a money saver. Back to you, Tyler.
Well, that brings us to the end of another episode of the Powercast. Our thanks to you for joining us. Also, thanks to Michael Grant of Calamos Investments, Steve Grasso of Grasso Global, and Liam Boggan of Quantmatix. And I guess if you have a takeaway from this week, it's that Liam Boggan doubles down on his call that the S&P 500 is overdue for a 7 to 10% correction. And all 3 of our contributors this week believe that while tech is still a great investing theme, maybe, just maybe, it's time to steer a bit away from those hyper-valued technology stocks known as the Magnificent Seven. Once again, thank you so much for joining us. Be healthy, be wealthy. See you the next time on Powercast. I'm Tyler Mathisen.